In the marble halls of the Federal Reserve, decisions shape the U.S. economy. And until yesterday, Governor Kugler was a key voice in that room. Dr. Kugler, a renowned labor economist, made history as the Fed's first Hispanic governor in 2023, bringing a much-needed focus on workers and families. Her background includes senior roles at the World Bank and Department of Labor, and her research always centered on how policies affect real people. Inside the Fed, she was a centrist, neither a hawk nor a dove, carefully weighing data before casting her vote. Her expertise on labor markets made her a swing vote, often tipping the scales in close debates. Kugler's departure leaves a void, especially as the Fed faces tough choices on inflation and jobs. She consistently reminded her colleagues that Fed decisions have real consequences for millions of Americans. Her absence removes a crucial perspective on the board just when the economy needs it most. The question now, what happens when that voice is gone? News of Kugler's resignation broke suddenly, no rumors, no warning, just a terse Fed statement citing personal reasons. Just days before, she was actively shaping policy and speaking optimistically about the economy. Her last public appearance showed no hint of an exit. She was engaged and forward-looking. Within 48 hours of a major Fed meeting, she was gone. The abruptness has fueled speculation. Was it policy disagreements, political pressure, or something else? Official statements are vague, but insiders say the decision was made in haste. Such a sudden exit is rare for the Fed, where governors usually serve long, stable terms. Immediate resignations often signal deeper issues, instability at an institution that depends on its reputation for calm and independence. Now the Fed faces uncertainty at a time when stability is needed most. The real reasons remain a mystery, but the impact is already being felt. Why does one resignation matter? Because the Fed isn't just any institution, it's the driver of America's economy. The Fed sets interest rates to balance two goals: stable prices and maximum employment. When the economy slows, it lowers rates to boost growth. When inflation rises, it hikes rates to cool things down. The 7 governors, including Kugler, hold the majority on the powerful FOMC, shaping every major decision. Each governor brings unique expertise. Kugler's was labor economics, making her the board's top voice on jobs. Without her, the Fed loses critical insight into how policies affect workers and families. It's like losing your best navigator during a storm. The remaining board must now steer through economic uncertainty without her guidance. As the Fed aims for a soft landing, curbing inflation without causing recession, her absence raises the risk of costly mistakes. The stakes for every American just got higher. In D.C., no major move is free from politics, and Kugler's resignation is no exception. With the 2026 midterms looming and talk of a Trump comeback, the Fed's independence is under pressure. Trump's past attacks on the Fed set a new combative tone, making the job tougher for governors like Kugler. Some insiders believe she left to avoid being caught in future political crossfire, choosing to exit on her own terms. Her early departure sidesteps a direct clash, protecting both her reputation and the Fed's credibility. Now, President Biden faces a tough confirmation battle for her replacement, with politics sure to dominate the process. The fight over her seat is really a fight over the Fed's future independence. As politics seep deeper into central banking, the challenge of keeping the Fed stable and neutral grows. Kugler's exit is a warning sign. The Fed's shield from politics is wearing thin. Kugler's exit injects fresh uncertainty into the Fed and your finances. Her centrist voice balanced the board. Now, more aggressive members may push for faster rate hikes. That could mean higher borrowing costs for mortgages, credit cards, and car loans, hitting Americans where it hurts. A more hawkish Fed risks tipping the economy into recession, making jobs and growth harder to come by. The White House now faces a bruising fight to fill her seat, likely leaving the Fed short-handed for months. Fewer voices at the table mean less expertise guiding critical decisions. Kugler's resignation highlights how fragile our economic institutions have become. The immediate loss is her labor market expertise. The long-term risk is a Fed more vulnerable to politics. Her empty chair is a symbol of the uncertainty facing the U.S. economy and every American's wallet.